Hello and welcome to our training session for Medicare Cost Report, Cost Assignment, and Allocation. In this session, we're going to be talking about unique cost centers, statistical allocation, direct assignment, and related topics. So first of all, let's go ahead and take a look at the agenda. We will go through an overview of costing in general, what that really means when we talk about it, what the purpose of it is. We will talk about the proper grouping of costs and charges. We'll look at how to request a change in unique cost centers, the direct assignment of costs to initial cost centers. We'll talk about what that means. The statistical allocation of general service cost centers. Number 6, how to request changes in statistical bases. Number 7, how to request the simplified cost methodology and what that entails. And then number 8, the direct assignment of general service cost centers, how to request that, some of the things you really need to be concerned with when you're requesting that, when you're using that. So let's go through an overview of costing in general. Section 2300 of the Provider Reimbursement Manual 15-1 sets the stage for the idea of cost basis and how that might be used in Medicare. Now, the way it reads, it says providers receiving payment on the basis of reimbursable cost must provide adequate cost data. However, we have acute care hospitals and other PPS type facilities. They're not paid directly based on reasonable cost, but the update factors, the DRGs to some extent, they're based on cost data. Now, even though the PPS facilities have been PPS for decades now, the acute care hospitals went in the early 80s, mid 80s, so even though they're PPS, they're not paid based directly on cost. The data's still important. They're still on the cost report. It's still a requirement, and we're going to talk about that and what that really means. So cost is directly used for reimbursement for some facilities, for example, critical access hospitals, but it's used for rate and update factor setting for other facilities like PPS facilities. In the end, cost is still important. That's the key thing there. So if we bring in a couple of additional sections, 2302.7 and 2302.8, the point 7 deals with cost finding. It defines that term, and it says it's a determination of the cost of services by the use of informal procedures. In other words, without employing the regular processes of cost accounting on a continuous or formal basis. So we're taking a look at direct costs and indirect costs. But the idea here, as we'll see in just a bit, is that the Medicare cost report is based on cost centers, and hospitals generally don't have cost centers in their accounting system. Instead, they have accounts, account numbers, account names. We'll see later how those accounts have to be grouped into cost centers from the cost report. So it's a little bit different there, and that's basically what they're saying. It's not grouped on a regular basis throughout the year. Instead, that's done at the end of the year as the cost report is prepared. So we have to use cost finding to make sure we take the accounting data and use it for the cost report. Now, 2302.8 defines a cost center. Now, again, cost center is very important for the Medicare cost report. That's the basis of that. But here they define it as an organizational unit, such as a department or a subunit, that has a common functional purpose where there are going to be direct and indirect costs accumulated, basically. So we'll talk about that. So now we get into proper grouping. An important concept here, I just touched on it a bit ago. The idea is that we have cost centers on a cost report, and they're not broken out the same way that accounts in either your general ledger, your working trial balance, or just your accounting system are. Now, hopefully you have a consistent way of grouping certain costs from certain accounts into a cost center on the Medicare cost report. Should be consistent over time for the most part. But the idea here is that we need to know where do they go. We need to take a look at the working trial balance and any grouping schedules that you've submitted. And we want to make sure certain things are consistent. I said earlier that there should be consistency across the years. But the other thing that's important is consistency within how revenues or charges are grouped to cost centers compared to how costs are grouped to cost centers. So they're two sides of the same thing. You have a charge for a service, and then you have an underlying cost for a service. They need to be grouped to the same cost center because the idea, in part, is that we're taking a look at what the markup was from the cost that actually you incurred in providing that service, how much was marked up to a charge or a revenue for that type of service. The idea is that markup, kind of the inverse of that markup, is used to back charges down to their underlying cost. Now, this methodology is used when we're dealing with ancillary costs on the Medicare cost report. There's actually a cost per diem that's used for the routine cost centers. But this idea is very important. Everything has to be matched accordingly. The revenues and costs need to be grouped accordingly. Now, one other important thing to understand is that when we talk about direct assignment later on, we're talking about a very specific aspect of direct assignment, dealing with direct assignment of otherwise general service or indirect type costs. In reality, all costs and charges start off as being directly assigned somewhere. And when we talk about direct assignment, this is just, in a way, it's another term for grouping. We assign something to a cost center. We group it to that cost center. We take all the accounts and group them or assign them to a cost center. But again, all of them start out as being directly assigned. The biggest question is, where are they assigned to? A lot of costs start off being directly assigned to a general service cost center. Capital, any of the overhead cost centers right there, that's what we're talking about there. But some costs, many costs, are directly assigned to routine or ancillary cost centers because that's where they belong. They don't belong to a general service cost. They are a direct cost by their nature. Now, Worksheet A, of course, is for costs. Worksheet C is where charges are grouped. As we said before a few times, the grouping must be reasonable and consistent. However, if you find that what was done in the past was indeed incorrect, maybe the charges weren't assigned in the same way that the costs were or whatever, or maybe there's a more enhanced, more sophisticated breakdown of cost centers that you can use, that's fine. But the change does need to be to enhance the accuracy. There needs to be support for that. Now, when we're taking a look at grouping, so this is reviewed during a desk review or an audit, depending on the level of scope. When we're taking a look at that, there are certain things that we would be looking for as auditors, and our auditors would be asking providers some questions based on this. One thing that pops up is that if you have multiple distinct revenue-producing departments. Now, by revenue-producing, we're basically saying they're not overhead-type cost centers. They're not general service. It's actually a department that has both a cost and a charge. So, for example, a clinic. Generally, these distinct revenue-producing departments should have their own cost center. There are exceptions. One big exception is the consolidation of rural health clinics. So if you have an RHC consolidation approval, then you can certainly merge multiple clinics into one. But some of the examples that come up quite often are operating room, anesthesia, and recovery room. They're all very distinct services. They all have their own charges. They all have their own costs. Even though, of course, somebody going into an operating room very likely gets anesthesia and very likely will need to go to a recovery room, they are still distinct stages of a set of services. So they should not be grouped into one cost center. In fact, the Medicare cost report by default has these as separate cost centers. So generally speaking, if you see something that's already broken out by default, most likely you should use it. There would have to be a very good reason not to use that cost center and to instead try to merge the costs with something else. So the idea of grouping, these are things we would be looking for. Another very important thing that we would be looking for is if non-allowable or non-reimbursable costs were somehow grouped into a revenue-producing cost center. And just as a note, when I say revenue-producing cost center, generally I'm talking about either routine cost centers like adults and peds, or ancillary cost centers that have their own separate charge for every type of service. That's what we're talking about. The operating room, lab, things like that. So in those situations where you have these non-reimbursable costs, they need to be split out, and a new non-reimbursable cost center needs to be set up to hold those costs. In large part, really the non-reimbursable cost centers serve two purposes. One of them is to make sure that those direct costs themselves fall out of the cost report. They're not allowable, so they fall off the cost report. The other main purpose of having a non-reimbursable cost center, as opposed to just using an A8 adjustment to adjust the direct costs out, the non-reimbursable cost center allows the cost report to also have overhead or general service costs allocated to that non-reimbursable item, so that the overhead drops off the cost report as well, because it's not allowed. Any underlying service that is not allowable needs to have the corresponding direct and indirect costs removed off of the cost report. The non-reimbursable cost center does that. So when we're taking a look at these reviews, we are especially looking at non-reimbursable costs by reviewing the general ledger, the grouping schedules, things that have labels that look unusual for that type of cost center. And we'd be focusing largely on costs that are grouped into like an administrative and general cost center. That's a common catch-all for things, but again, just because A&G is a high-level, somewhat catch-all type cost center doesn't mean that it's allowable to report non-reimbursable costs there. So that's what we're talking about there. The other thing, again, another reminder, I've said this a few times, the grouping of costs from Worksheet A must be consistent with the grouping of charges from Worksheet C. And the final thing we're taking a look at during our desk reviews and audits is just simply, is the grouping logical? So we take a look at, again, the labels, maybe the past history, how it has been done in the past with the provider, and we take a look and see whether that grouping makes sense. Does that label, does that account name seem to match that cost center? Does it seem like something that belongs there? And a lot of the questions that our auditors will be asking you are based on these types of things. So the reason grouping is so important is that every cost center has its own average markup structure. Every department has its costs that it's been incurring, and it has prices that it's set based on historical data, an expected amount of profit perhaps, things like that. Every cost center also has its own Medicare utilization. Now, of course, Medicare reimburses their share of the costs directly or indirectly. Directly, for example, for a critical access hospital, indirectly if we're talking about a PPS reimbursed hospital. So the higher the Medicare utilization, generally the higher the reimbursement. That means you're billing more for that type of service than if you had a lower utilization cost center. So the reason this is important is that everything needs to be categorized properly. The grouping must be accurate, it must be logical, and it certainly must not inappropriately shift costs. So some examples of things we'd be looking for are where more costs are being shifted to a cost center that either has a higher Medicare utilization, because, again, especially for a critical access hospital, that would mean that more of those costs would be reimbursed by Medicare because it's a high Medicare utilization in that cost center. Or there might be situations where there was a lower cost to charge ratio, which means that a certain amount of charges are equating to a much lower amount of costs. So there might be that situation where more costs were being included in that cost center. That naturally increases the cost to charge ratio. As an audit contractor, we're required to look at areas of risk, and these are certainly two areas of risk for the Medicare program. Now, the other grouping aspect that we're going to look at relates to indirect or overhead type costs. They must be grouped into a general service cost center, the overhead cost centers, whatever term you want to use, unless direct assignment has been approved, which would allow those types of overhead costs to really bypass the general service cost centers and instead go straight to the revenue producing cost centers. And this is discussed further. It's actually the last topic in this discussion. But ultimately, whatever costs are assigned to the general service cost centers ultimately are going to be allocated to the other cost centers that benefit from those services. Of course, those would be the revenue producing cost centers, like your routine or ancillary cost centers. There are a variety of others, but those are by far your more common ones. Now, when I say the word general service or the phrase general service, another word for that is indirect costs, overhead costs. These are the types of things we're talking about. And we'll see an example here right in this slide. This is a blank worksheet A. And by default, certain cost centers pop up, whether you're in the pretty much in the HFS system for a hospital. But on worksheet A, when you first open it up, even before you enter any of the data, you're going to see a variety of cost centers. Now, you'll start off with the general service cost centers, the overhead type cost centers, capital, employee benefits, your administrative and general, nursing administrative, nursing school, just a variety of them, housekeeping, laundry, and linen. So those are your overhead type cost centers. And then down below you start with your revenue producing cost centers, the routine, you can barely see the ancillary at the bottom. So that's the idea here. Whatever costs get directly assigned to the general service cost centers, later on in worksheets B and B-1, we're going to be allocating them to the routine and ancillary cost centers, and possibly non-reimbursable and others. But the point I'm making here is that the recommended, and I should have had quotes around that, the recommended cost centers are the ones that are pre-printed on worksheet A, or they're hard-coded into worksheet A. This topic is about changes in unique cost centers. These ones that are listed right here are not unique. If a provider decides to include new cost centers that are not listed, those are the unique cost centers that require pre-approval. So if you add any new cost center, it's considered unique, and it can be allowable. You can have several more cost centers if you have a more sophisticated cost accounting system. It does require pre-approval. Now the other thing, so in the HFS system, which again is what's used for hospitals, the way you would do that is by going to the Edit menu and Cost Center and Statistics Setup. Now when you're there, you see this setup window appear. You can actually add in new cost centers. You can, if they are a general service cost center, you need to identify a stat code and a stat label. Obviously, for the routine and ancillary costs, you do not need to do that. But more importantly, perhaps to avoid certain edits when you submit the cost report, when you are adding these cost centers, you'll see this code column. That's a cost center code. Now, certain cost centers have multiple codes available. Some of them only have one, and some of them allow for certain subscripts. The idea behind these cost center codes is to be able to tell CMS or anybody that's using this data what type, for example, of A&G is this. Is this A&G related to data processing, purchasing, receiving in stores, admitting, cashiering, accounts receivable? There's a pretty big list there. So you are supposed to choose the one that most closely matches it. Now, some of them can be subscripted, like this first one, the other A&G, has 35 subscripts you can use. But the point is you have to pick a cost center code to further break down what type of A&G that is. So these are the unique cost centers. Now, in order to be approved for the use of a unique cost center and expand above and beyond what CMS has already printed in the cost report, you'd want to follow the requirements of PRM 15-1, section 2313.1, the provider's use of unique cost centers. First of all, it must meet the definition of a cost center from 2302.8. So basically we're saying here it has to be some sort of distinct department, something you can track costs for, you can track charges for if applicable. It must be separately identified in a provider's accounting system, with any direct costs being recorded on a regular ongoing basis, not through just period end adjusting entries. It's something you have to be able to identify actual costs for. If it's a general service cost center, it has to follow the same basic allocation that is currently on worksheet B-1, and the underlying allocation, the sequence, the required sequence for overhead cost, is that whichever overhead cost serves the most other cost centers, that goes first. The one that serves the least other cost centers goes last. So capital is your best example. Virtually every department in a hospital uses some sort of capital, square footage, some machines, some equipment. So capital goes first. Employee benefits and A&G come next because, again, virtually every department or area of a hospital has some employees. Therefore, they should have some employee benefits. A&G is next, but then it just goes down the list. So the idea is that you should not be adding, for example, an A&G cost center. You should not be adding it to the bottom of the list by giving it a different number altogether. It needs to follow that same sequence. The other thing to note is that if we're talking about these general service cost centers, we also need to make sure we have a statistic for it. Now, I just said earlier how to add the statistic code. That shows you what we're going to use to allocate that cost out, square footage, pounds of laundry, things like that. You must convince the MAC, or the MAC must agree that it results in more accurate cost finding. A provider cannot just establish new unique cost centers just to increase the revenue or the reimbursement. It has to be something that can be defended as more accurate cost finding. Now, as far as the pre-approval, the written request must be submitted to the MAC 90 days before the end of the period, before the fiscal year end. The MAC will then turn around and review within 60 days. This approval, once it's given, is for all future years until a new request is made, or until something happens during audit that proves that the provider didn't have that auditable documentation to maintain that cost center, or it otherwise didn't meet the definition. So occasionally that happens, but usually it's prospective. Some examples of unique cost centers would be when either A&G or the capital cost centers are fragmented. And the idea here is that if you have, let's say, a new building, you have a brand new building and only one or two departments even use that building, then certainly it makes sense that the cost from that building would only be stepped down to those two departments. It doesn't need to be stepped down to all other cost centers. So that's a good reason for fragmenting capital. Occasionally, A&G, if you have sophisticated cost allocation, you can identify that some A&G only goes to certain areas. Data processing, for example, maybe that's only used by certain departments. So the question here, when a request comes in for this, we would need to know why and how do the costs relate only to that new cost center. How were they separated out? And is there a separate stat that can be used to properly allocate such costs to their corresponding cost centers? So these are the things we'd be looking for there. Now, I do want to point out on our website at WPSGHA.com that we have an article, several articles actually, under the Cost Statistics Charge Issues column. We have some on direct assignment. We have one just talking about the importance of accurate cost reporting data, Medicare charge allocation, requesting changes to cost centers or statistical bases, and direct assignment, step-down cost allocation statistics, and time studies. These all relate to the things I'm talking about in this video, so feel free to review some of those articles. The next topic I wanted to bring up is the direct assignment to what I'm calling the initial cost centers. So I'm not talking about the direct assignment that we'll see later on, where that's directly assigning overhead to a revenue-producing cost center. I'm just talking about essentially, again, the grouping. Direct assignment and grouping are essentially the same thing. But the issues I'm bringing up now are on worksheet A. We have two columns. Every cost center, I should say most every cost center, has two columns. The exception would be capital. They do not have a salary column. The column's there, but you cannot fill anything in those cells because, again, there are no employees that work for the equipment. It's not really a department per se. So that's the one exception. You'll have other costs there, and that would be depreciation, taxes, insurance, things like that that are capital related. And I guess I'll throw that out. That's an important thing. We are under the accrual basis of accounting. So when we're talking about capital, we're not talking about the purchase price of the capital. We're talking about the depreciation expense over time. That's what's going to be reported on Worksheet A. Worksheet A is not a balance sheet. It's more like the expense section of the income statement. That's about as close as we can get to that there. And again, it comes mainly from your working trial balance of expenses. As the name at the top says, it's the trial balance of expenses. Charges do not show up on Worksheet A, they're on Worksheet C. Now, the accuracy, it's not enough just to get costs grouped into the right cost center. They also have to be categorized properly as salary or other. This is very important for wage index purposes, for acute care facilities and other PPS facilities. The wage index is important to properly set rates, properly pay rates, calculate claims. So column 1 and column 2 are important there. Column 1 is labeled salaries, and that's pretty self-explanatory, but when you get into wage index reviews, there are some questions that come up. So column 1, the definition or the instructions say that you should be reporting in each cost center only the direct salaries and wages, plus things like vacation, holiday, PTO time, bonus pay. It's a salary-related item. Now, anything that are wage-related costs, so it's not a salary, but it's something that's related to it. It's a wage-related cost. Basically, your benefits, your employment benefits. These are defined in section 4005.4, and that's, by the way, the PRM 15-2. Those are the cost reporting instructions. So down here I included that definition. The benefits like retirement, insurance, tuition reimbursement, unemployment taxes, the employer's portion of the FICA taxes. Of course, the employee's portion, that's not a hospital expense to begin with. That's just a withholding from the employee. So those are the things that would go in column, they don't go in column 1, so they must go in column 2. And basically that's what column 2 says. Report in each cost center if column 2, all other costs not reported in column 1, including both wage and wage-related contract labor costs. That's a key thing. If you're not employing the labor and if you're contracting with them, then that should go in column 2. And then there are other things that go in column 2. A lot of cost centers have a large chunk of their costs going in column 2. Things they've purchased like supplies, materials, other purchased items that have been used. Keep in mind we're under the accrual basis of accounting, so it's not just the purchase of supplies, it's the use of supplies that matters. Utility bills paid, assets that have been purchased, but then again, they have to have been used. It's the depreciation of those assets, assuming they're depreciable. As a reminder, it's the accrual basis of accounting. We're not under the cash basis of accounting. It's not just the purchase that matters. Now, the direct assignment that we're talking about, again, we're assigning overhead. We're grouping overhead, but generally this should be to a general service cost center. General service costs should go to general service cost centers, unless an exception has been approved. That's where they belong. Later, they're going to be allocated to non-reimbursable cost centers and revenue-producing cost centers. The important point here, though, is that these overhead and general service costs cannot be assigned directly to the revenue-producing cost centers, the routine and ancillary cost centers, unless that method has been approved. I will say, even before we get to it, out of all the approvals that we talk about, the stat changes, the unique cost centers, the simplified method, the direct cost assignment has the most stringent requirements, and we're going to discuss this quite a bit later. So when we start talking about the statistical allocation of general service costs, the idea here is that we've directly assigned the general service costs to the general service cost centers, and now we need to figure out how much of that cost ultimately belongs with the revenue producing cost centers like routine and ancillary. How much of that underlying service did the emergency room use up? How much did the adults and peds cost center use up? All of that cost needs to be allocated down, because by the end of the cost report, the end of worksheet B, none of that overhead cost can remain in the overhead cost centers. It needs to have been allocated through what's known as the step-down method to those other cost centers. Now, for those of you that have an accounting background, or maybe you know this term for other reasons, but this idea of activity-based costing, or ABC. It's a cost accounting concept, and the idea is that we're taking these costs that have already been broken out into multiple cost centers, we're identifying certain statistical bases, which another term for that is a cost driver, something that we can measure that shows how much of that cost belongs in a certain area, how much of that service has been used. So we identify the statistical base, we enter the actual statistical quantities, like the number of square feet each department uses out of the total square feet, the number of pounds of laundry each department uses out of the total pounds of laundry. These all go into worksheet B-1. And again, through this that we'll continue talking about, we're performing something that's known as activity-based costing. Instead of allocating all overhead based on just one measurement, we allocate each different cost center, which you could have 10, a dozen, 20, depending on how many you've broken it out to. But we use all of those different statistics or cost drivers. It results in much more accurate cost finding. So here's just an example of worksheet B-1. Worksheet B represents the costs, the overhead costs after they've been allocated down. Worksheet B-1 is where the statistics are actually entered. So again, they're referred to as statistics in the Medicare cost report, but they're actually cost drivers. So square footage, the amount of square feet that each department uses as a percent of total, represents how much of the overall building cost center or cost that they will get. In this case, the dollar value of all the movable equipment. So if, let's see an example. If the adults and peds, that's maybe not the best example. Some of the ICU areas, the operating room, the emergency room, if they have a lot of the total movable equipment, if they have a higher percentage of the total movable equipment, dollar value wise, then they're obviously going to get a larger share of the movable equipment depreciation, etc. So that would be a statistic. Gross salaries, that's a standard statistic used for employee benefits. If one department has the largest share of salaries in the hospital, it's also going to get an equivalent share of the employee benefits. That's perhaps the most sensible one in the entire list. A&G, accumulated cost, this is one that doesn't have a very, very accurate cost driver. There's no really refined way of doing this. So what we're saying is all this A&G cost that we have no better way of allocating out, we're just figuring out up to this point how much cost has already been either directly assigned or allocated to this cost center compared to how much has been allocated to all cost centers in total. Whatever that percentage is, that's essentially how much of the A&G cost that department is going to get. You'll notice that there are a couple of other cost centers by default using square footage to allocate. Pounds of laundry for laundry and linen, that makes sense. Hours of service for housekeeping. So these are all statistics / cost drivers that help us to allocate the overhead cost out to the various cost centers. Now the way it's done, I used a percent to total explanation earlier, and that certainly mathematically works. But the way it's done on the cost report is that you take the total cost from worksheet B for that one overhead cost center, you divide it by the total quantity of whatever stat that cost center is using. the total square footage that it has, and that gives you what's known as a unit cost multiplier. So this is an excerpt from B-1 at the very bottom, line 202 and 203. Every cost center has its own unit cost multiplier. This is, to use another accounting concept, it's just an activity-based cost driver rate. So it's the rate per square foot that each department is going to get. So if that square footage cost ended up being $1.25, then every time there was a square foot in a department, they'd get $1.25 of that total cost. So to allocate the actual cost on worksheet B, you take that unit cost multiplier for that particular column, and then you multiply it by the number of, like I said, square feet for that one cost center under this column, and that determines the amount of overhead cost that it's going to get out of that one column. You basically repeat the exact same thing column after column after column until all of the overhead cost centers have been allocated. Now we're on to the next topic of the statistical allocation of general service costs and how to request different statistical bases. So at the very top of a blank cost report, if you look on worksheet B-1, as we just did back here a little bit ago, these are the standard statistics. These are the default statistics. And if a provider wants to change those, they can do so if they believe it's more accurate, but they have to have MAC pre-approval. One thing to note is that the difficulty of gathering that statistic is not in and of itself a justification for changing it. Instead, the justification has to be that we have a more sophisticated statistic that'll give us better, more accurate costing. If we go to PRM-1, 15-1, section 2313, this is where you'll find the instructions for how to request a change in the statistical base. First of all, it must be more accurate. There is one exception that we'll talk about the next slide. That's when you request the simplified method that you're locked into for 3 years. We'll talk about that in a bit. So it has to be more accurate. You must have auditable documentation for that statistic. You must be able to explain how you gather that, how you ensure that it's accurate, all of that. Just like the other requests, this request must be made 90 days prior to the end of the period, and the MAC will review it within 60 days. And kind of as an overall requirement, there can be no inappropriate shifting of costs. So if something doesn't look like it's going to be more accurate, instead it looks like more of a cost shifting goal, if you will, that would not be approved. So next we'll discuss the simplified cost allocation methodology. And this one is discussed in the actual cost reporting instructions. That's PRM 15-2. That's section 4020. It's basically your worksheet B part 1 and B-1 cost reporting instructions. Now this in red is a quotation from this instruction. As an alternative approach to the cost finding methods identified in 15.1 chapter 23 section 2306, the provider may request a simplified cost allocation methodology. This methodology reduces the number of statistical bases a provider maintains. It may result in reducing Medicare reimbursement. So you're doing it for simplification, not so much a reimbursement issue. A comparison is recommended if you believe that you're going to lose more Medicare reimbursement than you're going to save in costs of maintaining those statistics. Because again, that's the entire purpose for it, to cut down on the need to maintain some of those statistics that may cost money and time to maintain. The following statistical bases must be used for the purposes of allocating overhead cost centers if you request and are approved for this method. I have this next section in bold. There can be no deviation of the prescribed statistics, and it must be utilized for all of the following cost centers. So here's the list. You'll find this in the cost reporting instructions for worksheet B and B-1, and you'll notice the square footage is used for quite a few things. These are simplified statistics. You don't have to keep nearly as many statistics, basically. I mean, just one example, laundry and linen. Now you're using patient days. If you just required, or if you just requested the laundry and linen cost center by itself to be moved from hours of laundry to patient days, chances are that would be denied because hours or patient days doesn't really do a great job of accurately allocating that cost, whereas pounds of laundry used, that's a perfect statistic. It's just that it takes time to measure. It takes time to gather that, so a facility may try to get away from that by requesting this simplified method. That's perfectly allowable. So these statistics must be used. These cost centers must be used. This has been clarified by CMS in the past. The phrase no deviation does indeed mean no deviation. You cannot add new cost centers. You cannot fragment A&G or capital costs. There can be no other unique cost centers. If you're trying to go under the simplified cost allocation methodology, you can't at the same time try to be more sophisticated for certain things. It's an all or nothing approach. Now, there are a few exceptions that CMS gives, even if the simplified election is made. So you can read worksheet B-1. There are just basically a couple alternative statistics that can be used instead. Again, they have it bolded, or they have it underlined here. The election of this method cannot result in inappropriately shifting costs. The goal has to be simplification, not reimbursement increase. Here's the other important thing about the simplified method. Once you've elected it, you're locked in for at least 3 years unless there's a change of ownership. So it's unlike any other request where you can come in or out of it. The 90-day and 60-day pre-approval rules still apply. So the final topic for this video is going to be one that's a little more in-depth and not nearly as common, but it relates to the direct assignment of general service costs. So I said this a few times earlier. All costs are directly assigned somewhere, but what we're talking about with this particular request is when an overhead cost is directly assigned to a non-overhead cost center. So it basically bypasses the general service cost centers, and it's directly assigned to a revenue-producing cost center like a routine or ancillary in lieu of going through the normal step-down allocation. Now, this has a lot more requirements for it. There are more stringent approval requirements, and one thing that's very important to understand is that the time frame, the 90-day and 60-day rule, is a little bit different here. It's intentional. The direct assignment approvals, the request, must be submitted prior to 90 days before the beginning of the cost reporting period. All of the other requests, stat changes and unique cost centers, were due 90 days before the end of the cost reporting period. The reason for that is there's a much higher chance that this request is going to be denied just because of all the requirements there are. And by the nature, if you're doing direct assignment, you need to know whether it's approved or not very early on in the process. It's not good enough to know right at the end of the process. Even for the other requests, stat changes, unique cost centers, we still recommend they're submitted prior to the beginning of the cost reporting period, or at least very early on, because if it is denied, then what that basically means is whatever the previous statistic was, you're still going to have to use that. You're going to have to find a way to come up with that data. This one would be much worse if a provider went through the year thinking they were going to be able to be approved, and then they find out at the end that they're not, because the data may no longer exist to do that allocation. So it's submitted prior to 90 days before the beginning of the cost reporting period, beginning of the fiscal year end, or fiscal year begin, It's PRM 1, 15-1, section 2307. That's where you'll find the requirements for this. Now, if you read through 2307, it is fairly lengthy for the direct assignment requirements. Now, what I have here in the next few slides is basically a screenshot of the relevant sections of this. I'm going to read through some of these, but I'm also going to add some commentary to this to try to clarify it a bit. So the intro portion to 2307, it says that the costs of a general service cost center need to be allocated to the cost centers receiving service from that cost center. The allocation process is usually made for Medicare through cost finding using a statistical basis. We've talked about that up to this point, and alternatives are available if they have proper approval. The provider must make a written request to the MAC no later than 90 days prior to the beginning of the period. We talked about that. The MAC will respond in writing, and you'll know before the beginning of that cost reporting period whether it's going to be allowed or not. When the request is approved, the change must be applied to the cost reporting period and all the way in the future unless a timely request is made to change it, to revert back. So down here, subsection A, or paragraph A, I should say, it says that the direct assignment of cost is the process of assigning directly allocable costs of a general service cost center to all cost centers receiving the service from that cost center, and here it's key, based upon actual auditable usage. That's a very key phrase. We're no longer using a statistic to estimate how much of that cost belongs in each cost center. What we're saying here is that there's something auditable that shows how much was actually used. Some examples that are given: hours worked by hourly wage. If you have the hours, that's a perfect way of tracking how much cost goes there. In fact, that's how a large chunk of the costs that are already directly assigned to revenue producing cost centers, the salaries, that's how they are calculated to begin with. Another example that comes up from time to time would be separately metered utility consumption. Those are all actual usage. Now again, there are other things you could have, but they have to be actual and they have to be auditable. Any sort of estimate, they talk about statistical surrogates like square feet, they're not acceptable because that goes right back to the whole reason we're using step-down allocation anyways. That should have been reported in a general service cost center and stepped down using that square footage. Another thing that is commonly overlooked is this discussion about time studies. Time studies in and of themselves are estimates. They're using a certain portion of the year to project or predict or estimate how much of that employee's time would be used throughout the rest of the year. It's not accurate. It's not 100% accurate like an ongoing time report would be. Therefore, it can't be used as the basis for direct assignment of overhead costs. It can be used for the direct assignment of revenue producing cost center cost, but it's not allowed to be used for overhead costs. The main reason is there's another way, using a statistic through the normal step down. If we continue on, indirectly allocable supervision costs, other indirectly allocable costs, or residual costs, that's a good term that we're going to use, things that couldn't otherwise be allocated or assigned, and costs allocated from previously allocated general service cost centers, so again, just more overhead that's accumulating, must not be directly assigned to the using cost centers, but must be allocated through cost finding. So the idea here is that with these, there would be no good way of getting that direct actual usage anyways. So these would be left to be allocated through step down. Again, I wanted to point out that I said we use time studies for the other cost centers, the non-general service cost centers. That's perfectly fine. And this note tells you that's perfectly fine. It says these direct assignment of general service cost centers, that's distinguished from the allocation of direct salary and wage costs from 2313.2e. In other words, all these requirements are just for general service costs. There's no special rule for directly assigning a revenue producing cost center. That already by nature is directly assigned. The direct assignment of costs must be made as part of the provider's accounting system, with costs recorded in the ongoing normal accounting processes. So you have to have this tracked along the way. It cannot be an estimate made at some point in the future or at the end of the year. So they cannot be period ending adjusting entries. For example, if the costs being directly assigned are an element of payroll costs, the direct assignment should be recorded as often as payroll is. Every 2 weeks, every month, whatever it might be. If a provider fails to maintain the records as specified in its request and as a basis for the max approval, then no direct assignment of costs is allowed for that cost reporting period, and it basically terminates your direct assignment. Regardless of whether it was approved or not, if you're not keeping the auditable documentation, now it's terminated. And a new request would be initiated for direct assignment in the future. Some examples here of acceptable direct assignment would be salaries paid to housekeeping staff. That could be directly assigned. If you know who was working on certain rooms in certain areas, if you can directly track their salary, then instead of going through the normal housekeeping cost center, certainly you can pull that cost directly down to those cost centers, those revenue producing cost centers. Purchase laundry and linen costs. If you know how much laundry and linen was charged to each department, then certainly there's no problem. You can directly assign that. It has to be based on invoices. There might be situations where certain movable equipment is only used in one department. So it calls into question, well, why would you need to report it along with the pool of other movable equipment and allocate it down based on square footage or dollar value? If you know that one big piece of equipment was only used in the radiology department, that's a classic example, it's never used anywhere else, then that's a candidate for direct assignment. A building that is only used by one department, another classic example there. Now we're starting to get into some of the conditions that must be met before we can approve it. Number one, all costs within the general service cost center that can be directly allocated, or this really should be directly assigned, must be assigned to the benefiting cost centers as part of the provider's routine accounting process. What this basically means is if you're making this direct assignment request, it's kind of all or nothing. You either directly assign everything that you have the documentation for, or you don't directly assign any of that overhead cost. So you cannot pick and choose. That's a key thing there. You can't say, I'd like to directly assign this one thing, but not these other things, even though I have the documentation to do so for those other things. Number two, any indirect supervision and residual costs that remain in the cost center along with any previously allocated overhead, in other words, something that wasn't directly related to that anyways, that cost center, this must be allocated through cost finding rather than being directly assigned. So just by their nature, there's no way of knowing how much of the supervision costs or what other residual costs there are. There's no way of knowing how much would go to each individual cost center. So that has to be left for a step down. Number three, the basis for assigning directly allocable costs must be on a factual and auditable basis. We said that earlier. You cannot use averages. You cannot use estimates. You cannot use any sort of statistical surrogate or a time study. They give this example again of housekeeping. You have to track the hours, the actual hours worked throughout the entire year, not some time study, not some estimate, the actual specific hours worked by that particular housekeeping employee in each of the different departments or cost centers throughout the year. If you know the actual hours and you can multiply it by that person's hourly rate, you have an amount that you can directly assign. That's perfectly fine. Number four, the basis of allocation for cost finding of any indirect supervisory costs or residual costs must be some sort of appropriate measure. It must be a good square footage, a good statistic to allocate the costs out to the cost centers. In other words, those are left. Those have to go through normal step down. They cannot be directly assigned. And as we said before, if they are changing the allocation basis, that would be a separate thing altogether. You could technically have a direct assignment request paired with a change in statistics for what's left. There's nothing wrong with that. And let's see, we take a look here. The example they're giving, a building of two buildings of differing ages and depreciation, and you can identify what department is using each of those buildings. You could do that. Separate metering of utilities, basically the same things we're talking about there. We talked about earlier. Now, anytime you have these additional general service cost centers, basically when you add a new cost center, a unique cost center, you've been approved for it, you've added it, the cost reporting software, it adds additional columns to the allocation worksheets, the B-1. It basically, this paragraph is a little outdated because for quite some time this has been done automatically by the system, by the cost reporting software. Now, if during the desk review, let's say we've approved direct assignment, and if during the desk review we find that the documentation is just simply not there, then this cost, it'll basically be reverted back to the general service cost center and will go right back to the normal step-down allocation. So just because you've been approved for something up front doesn't guarantee it's going to be allowed at the time of audit, because the approval was conditioned on the fact that you have the underlying support for that direct assignment. We're not going to be reviewing the support itself up front because it probably doesn't even exist at that time. The year hasn't even started. So it's a condition that you must meet to maintain that approval during that cost reporting period. So it's incumbent upon you to keep the adequate documentation that can be audited to support that direct assignment. And if it's not there, again, we're going to revert back to your normal cost finding using the step-down allocation method and the cost drivers, the statistics. So that other requirement here is that this is a kind of a repeat of what I said earlier. Once you request direct assignment, it cannot be selected just for a few cost centers. It has to be used for any cost center and any type of cost that can feasibly be directly assigned. If you have a cost center that looks like it should be able to be directly assigned and you're not including that as part of your direct assignment, the burden of proof would be on the provider to show why it doesn't make sense to directly assign that particular cost, why you can't have the documentation, why that one has to remain as a step-down allocation. So basically any situation that we see where a cost that would normally be assigned to a general service cost center is instead being assigned to a revenue producing cost center, by its nature, by its definition, that's a direct assignment situation. And we are going to, first of all, look for the approval. The approval must have been given prior to the beginning of the cost reporting period. And again, there must be the auditable documentation since that approval. So when it comes down to this, when the auditors are taking a look at this throughout the desk review or audit, they're going to be looking at the trial balance, they're going to be looking at the grouping schedules, and they're going to be looking at these cost labels, the account numbers, the account names, the labels, and they're looking to see if there's anything that was assigned or grouped to a revenue producing cost center, but it seems like it should be something that relates to a general service cost center. If they find things like this, the first thing they would do is ask questions, ask for clarification. They'd look at how something was treated in the prior year, what approvals were granted, and ultimately, based on the findings, they're either going to allow it as direct assignment if it was approved and it was documented, or it's going to be regrouped or reallocated, reassigned, I should say, to the general service cost center that it most logically relates to, and it'll be stepped down from there. So that takes us to the end of our discussion in all of these costing type topics, especially the direct assignment. Direct assignment, just by its nature, is a much rarer situation, but when the documentation exists, it can certainly result in more accurate cost finding. So I thank you for your time. I hope this has helped to clarify these topics. And if you have any questions, please feel free to send those on. Thank you.